All right, welcome to this explainer where we are going to unpack the absolutely massive, record-breaking Q3 2026 earnings report from Moog Inc. Whether you're someone who tracks the aerospace and defense sectors like a hawk, or you're just looking for a literal masterclass in how a company uses operational excellence to completely shatter its own records, you are definitely in the right place. Even if you don't hold a single share of Moog stock, what we're looking at today is a textbook example of transforming market hype into cold, hard cash. We're going to stick straight to the facts today, the numbers, the segments, and the guidance updates right from their latest report.
Let's kick things off right at the top with a truly staggering number, $1.117 billion in net sales. And look, this isn't just a slight beat. This represents a formidable 15% jump from this exact time last year. Now, in the highly complex world of aerospace manufacturing, trying to add that much top-line growth in a mature market is notoriously difficult. So crossing that billion-dollar threshold in a single quarter, that is a major milestone, and it really sets the stage for everything else we're about to dive into today.
And you know, the leadership team over there knows exactly how they pulled this off. CEO Pat Roche really hit the nail on the head in the earnings release, saying that these results demonstrate the true strength of Moog's portfolio and their operational excellence. He specifically credits this success to the company being incredibly disciplined, highly selective with where they put their money, and just uniquely capable of turning raw market demand into undeniable financial performance. So here's our game plan to understand how they did it. We'll look at those record-breaking headline numbers, break down the growth segment by segment, uncover the special windfalls boosting their margins, and finally, we'll see exactly why they're raising the bar for their future guidance.
Okay, Section 1, a record-breaking quarter. Let's get right into what made this quarter so historic for them.
When you look at the raw financial momentum here, Moog didn't just grow, right? They completely shattered their previous baselines across multiple key metrics. We're talking record sales and record adjusted earnings per share, paired up with some incredibly strong cash generation. It's basically the trifecta of financial health that investors dream of waking up to, mainly because it proves they aren't just selling more stuff, they're actually keeping more of the money they make. Let's put some real numbers to that momentum. Like we said, this wasn't just a top-line revenue win. Their adjusted earnings per share rocketed up by 60% to $3.72. They generated a very impressive $133 million in free cash flow, which is up $40 million from last year. But honestly, the most crucial indicator of their future stability is their 12-month backlog, which increased by 23% and is now sitting at a massive $3.3 billion. In this specific industry, your backlog is your ultimate financial safety net. It means that even if the broader economy stumbles tomorrow, Moog has secured demand just waiting to be fulfilled. That demand isn't just theoretical, it's secured, it's contracted, and it is ready to go. Moving on to Section 2, growth across all segments. Where did all of this explosive growth actually come from? Let's break down the revenue. Well, as you can see, a core strength from Moog right now is that there is practically zero weakness in their portfolio. Every single segment saw phenomenal growth. Space and defense grew 17%, military aircraft was up 9%, commercial aircraft rose 17%, and industrial actually topped the whole chart with an 18% jump. It is super rare to see a business of this size and complexity firing on all cylinders simultaneously quite like this. Let's zoom in a bit closer. Space and defense led that top-line revenue, bringing in $336 million. According to their report, this was driven by broad-based defense demand, specifically led by missile controls and space vehicles. Meanwhile, the commercial and military aircraft segments got a nice boost from higher volume, solid pricing power, and really strong aftermarket activity. And just as a quick reminder, strong aftermarket activity is incredibly lucrative because servicing and repairing existing fleets almost always carries much higher margins than building entirely new equipment from scratch. But honestly, here is what I find really fascinating: the industrial segment. Now, it's probably not the first thing that pops into your head when you hear the name Moog, but it actually saw the highest percentage jump of the quarter, 18%, bringing in a very solid $282 million. So while you'd absolutely expect aerospace and defense to be booming given the current global dynamics, Moog is finding this highly unique way to capture the artificial intelligence and cloud computing boom. How? Well, they're rapidly ramping up their manufacturing capacity to meet an exploding demand for data center cooling pumps. While all the big tech giants are making the front page for their AI chips, Moog is quietly supplying the literal plumbing that keeps the AI revolution from completely overheating. Because as these data centers scale up to handle massive AI workloads, they generate unbelievable amounts of heat, and Moog is perfectly positioned to provide the precision fluid controls needed to efficiently cool the whole operation down. Okay, Section 3, Margin Boosters and Windfalls. Let's shift gears and look at the margins to understand how Moog is keeping so much more profit for every dollar they earn.
Quick refresher for anyone who might need it before we go deeper. Moog reported their margin expansion in basis points. This is just standard finance lingo where 100 basis points equals 1%. So, in this quarter, Moog reported 280 basis points of adjusted operating margin expansion. That just means their profitability margin grew by 2.8% compared to last year.
But to really get a read on this quarter's true health, we've got to play detective a little bit and separate their pure, organic, operational wins from a massive one-time windfall they got. Specifically, we're talking about a large refund they received from historic international trade tariffs known as IEPA. Let's look at exactly how the math breaks down.
Let's build this out step by step. So we start at last year's baseline of 13.6%. First up, we actually have to subtract a 70 basis point headwind, simply because they didn't have a non-core product line sale like they did last year. Next, we add 80 basis points of pure organic business performance and operational excellence. That right there is the core health of the business intrinsically improving. And finally, we add a massive 270 basis point boost from $30 million in IEPA tariff refund claims. So, the takeaway here is absolutely crucial. Yes, the massive tariff refund gave them a giant windfall to reach that 16.4%. But their baseline operations and simplification initiatives are still definitively improving the core business margins all on their own.
Which brings us to Section 4. Raising the future bar.
With an incredible quarter in the rearview mirror and that $3.3 billion backlog securing the future, Moog has confidently raised their July guidance compared to what they predicted just back in April. They are now projecting $50 million more in total sales, bringing the new target to $4.385 billion. They've bumped up adjusted operating profit by $37 million, and they have significantly boosted their adjusted earnings per share target by a full $1.05, bringing it to $11.65. Listen, raising guidance mid-year like this is basically management's way of flashing a giant green signal to Wall Street that their momentum is locked in for the long haul.
On top of all that, they've also bumped up their expected free cash flow conversion from 60% all the way up to 70%. Now, this is a massive indicator that their 80-20 simplification initiatives, which is a strategy of focusing ruthlessly on the 20% of efforts that yield 80% of the results, are actually working beautifully. They aren't just out there selling more, they are operating so much leaner and converting a much higher percentage of those sales into actual usable cash.
So, ultimately, when you take a step back and look at this whole picture, with operational excellence driving core organic growth, $3.3 billion in backlog just waiting to be fulfilled, and surprising new markets like data center cooling rapidly expanding, we really have to ask, is this record-breaking quarter just a lucky anomaly, or is this simply the new normal baseline for Moog? It is a genuinely fascinating question to consider as we watch their whole strategy continue to unfold. Thanks for joining me on this explainer today, and as always, keep questioning the data.